Holy flippity flip flapping smokes, everyone! Things have gotten so bad, I've lost my hair. But if you think it's bad now, something even worse could be about to happen. And something I'm very, very worried about, and something that did just happen the past week. The Federal Reserve may actually shut down CPI, or the CPI we like to call it, inflation data altogether to avoid the unthinkable, to avoid huge defaults with consumers, but most importantly, the US government. Because people, we are now starting to get the data that things have taken a turn for the worst. Yes, while the markets are rallying on hopes that the Federal Reserve will pivot, in the real world, things are getting very, very bad. We're seeing mass layoffs starting to begin. We're seeing consumer demand and consumer spending is falling, and people are falling more and more behind on their payments. What you have to know is the markets are not the economy, and the markets often get things wrong. So people, I have huge new news, huge new facts and data to show you today about how things in the real world are getting worse, and also how the Federal Reserve is going to start manipulating the inflation data as well as the BLS. So people, this is going to be a very, very important show. Let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, first things first, and this is the first sign that things are getting worse, people, and consumers are in a worse position. Americans fall behind on car payments at a higher rate than they did in 2009. Automobile repossessions are climbing as inflation forces struggling consumers to make tough choices. So these are all early signs that we're starting to see that people are in big, big trouble. I've been showing you the charts, how people's savings is going down. Their debt is skyrocketing. So now what's going to start happening is it going to start falling behind on their debt payments? Bankruptcies are going to soar in 2023. Delinquencies, defaults are going to rise. And you're going to have to see people start selling their cars to keep up with the high cost of living, start selling more and more of their items in the home. And we're already getting proof that that is happening right now. Because look at this, wholesale used car prices are down 14.9% year over year, the largest annual decline on record. So that's right, people. I've been warning about how the used car market has been in a huge bubble because people not wanting to catch public transport in 2020, 2021. Also, people were given huge amounts of stimulus checks, so they went out there and spent on crazy on buying new cars. They were able to get very, very cheap debt at 2% interest, even lower in some circumstances. But again, now the cost of living is rising and having to sell off their cars to keep up. And listen to this story of how people are really struggling hard. When 21-year-old Kobe Hatch walked outside his Chicago home in December and couldn't find his 2013 Dodge Journey, he knew it had been repossessed. He'd been falling behind on payments for months. Without a car, he couldn't do his job as a delivery driver for Amazon and got fired. Now he's struggling to make his rent payments and can't afford groceries, even with food stamps. It's been very stressful for the past few months, he said. Inflation has really taken toll on people. That's exactly right, everyone. And I'm sure there's many people in the same situation as Kobe right now. They've had their car repossessed, they're falling behind on rent, grocery bills are skyrocketing, so they simply don't have any discretionary spending left over to spend. Sure, there is a few, global elites, the 1%, they'll always be fine in no matter what economy they're in. But in the real world, for the majority of the middle class, they are getting absolutely destroyed by inflation. And again, I'll get into a moment how the Federal Reserve is going to manipulate this and how the government is going to manipulate this data in just a moment. Listen to this. Now more Americans are falling behind on their car payments than during the financial crisis. In December, the percentage of subprime auto borrowers who were at least 60 days late on their bills rose to 5.67%, up from a 7-year low of 2.58% in April 2021. Again, people, I've been showing you all the data is saying things right now in many circumstances are actually worse than what they were in 2008. And you know what's even worse in 2008 as well? There is much more debt in the system. And what we're doing is we're lifting interest rates at one of the fastest paces ever. So what this is going to lead to, it doesn't take an economist to figure this out. We're going to see huge pain in the economy, but the markets don't get it yet. There's this huge optimism because the CPI has been coming in lower and lower over the past few months that, the soft landing is going to be able to be pulled off by the Federal Reserve. But unfortunately, people, the data lags. I don't think this is going to pull off unless they shut down or change the CPI data like they have done in the past. This wouldn't be the first time, people. They've made huge changes in the 80s and in the 90s, and that's why they've said that they can do this quantitative easing, print as much money as they want, and they say we've had low inflation over the past 30 years, when in real terms we haven't. They've just manipulated data, because there's a saying, there's lies, damn lies, and then there's statistics. Because remember, last year in 2022, we had what we all agree is a recession, 2 negative quarters of GDP, but the government just came out and said, well, you know what, we're going to change the definition of a recession, so we'll just ignore it, say there's no recession, so everything's fine, isn't it? Now, the one thing that has stopped us from heading into a severe recession is the unemployment rate. Unemployment rate's been at 50-year lows, but that's all about to change. And when people start losing their jobs, that's when we're going to see people fall further and further behind on their rent payments. Like what we've seen with people falling further and further behind their car payments, is going to get even worse. And that's when the real great recession or depression will begin. And that's what the markets aren't prepared for at all. But look at this data we're getting now. So this is what we saw in 2022, everyone. We saw huge amounts of layoffs, but I'll get into a moment how there's even more layoffs being announced. So DoorDash laid off 6% of its workforce in November. Redfin laid off 13% of its workforce. Amazon, which I'm going to go over in a moment, they're announcing more layoffs, around 18,000. Meta laid off 13% of its workforce. Twitter, Elon Musk went absolutely beast mode. He sacked half of the workforce, and he's done even more layoffs now. Zillow laid off 5% of their workforce. Peloton 12%. Snapchat laid off massive 20% of their workforce. We see more and more layoffs were announced. Robinhood 9%, Peloton 20% as well. But look at this, people. It's only January, and look at how many companies have announced massive layoffs. IBM is going to slash 1.5% of their workforce, 3,900 employees. Gemini, 10% of its workforce. Yankee Candle, they're going to sack 13% of their workforce. Spotify, another 6%. Google announced 12,000 employees will be laid off, 6%. Microsoft, 5%, with around 10,000 jobs going. Amazon, they've doubled their layoffs from 1% to 2%. 18,000 jobs are going to be lost to Amazon. And this is just the start, everyone. Coinbase, 20% of their workforce. Salesforce, 10% of their workforce is going to be laid off. Goldman Sachs, the banks, they're still starting to have some layoffs now, with 8% of their workforce being laid off. And again, we're just in the first month of the year. So like I've been warning people, the data always lags what the Federal Reserve's doing. And yes, while there's hoping that they're going to pivot, remember, they still are going to lift interest rates. It's very likely they're going to still lift interest rates 25 basis points this month and next month. And again, we won't get the worst of it until 6 to 12 months after the Federal Reserve rate hikes peak. We still haven't hit the peak yet. So this, to me, what I'm thinking what's happening in the markets is a lot of hopium that the Federal Reserve will pivot. And again, I'm going to get into in a moment, if they do change this data, and I'll show you what's been announced, they may be able to cover up the real catastrophic damage that is going to be coming. Because look at what's happening here, everyone. This is a DXY, the dollar index. And we can see here, it has been absolutely tanking. It's crashed over around 10%. But what this means is imports are going to become much, much more expensive. And yes, while we've had low inflation over the past 3 months, if the dollar keeps on tanking, that will make inflation worse over the long run. If commodities keep on rising in price, seeing oil is now starting to increase again. But again, what we're all here for, how could the Federal Reserve actually shut down the inflation data or manipulate it to cover it up? Well, the BLS, who releases the CPI reports, have just announced a huge change for 2023. Look at this, everyone. The Consumer Price Index, January 2023 CPI weight update. Starting January 2023 data, the BLS plans to update weights annually for Consumer Price Index based on a single calendar year of data using consumer expenditure data from 2021. This reflects a change from prior practice of updating weights biannually using 2 years of expenditure data. So what this simply means is, instead of comparing prices over 2 years, they'll just compare prices over the past year. So price increases won't seem so dramatic when they're only comparing year-over-year data. And if you think this is the only time they've done this, no, they have made these huge changes in the past, which has made inflation seem lower and lower, so they can keep the money printer going and keep dropping interest rates lower and lower. But what have we seen? The real world effects of this. We've seen the middle class purchasing power, the standard of living since the 70s and the 80s has gone down significantly. Remember, there used to be households of just the father working with a family of 5 or a family of 7, him just working at a factory and surviving on just a middle income wage. well, those days are over. Even if people are making six figures, in some cases, if they're living in California, New York, they're not living very lavish lifestyles at all. Because this is what inflation would be if they based the CPI off the way they did in the 1980s. Inflation would actually be 15% right now. And I know all of you are watching, you will think that's much more realistic. You think that's much more close to home what the real inflation figure is, not 6% like they're saying. But then they changed that, and based off the 1990s model, they're saying inflation would only be 10%. Again, that's still much higher than now, but you can see it is much lower than the way they used to do it in the 80s. And of course, now they're saying inflation's only 6% when we all know it's much higher than that. So something I'm very, very worried about, and this is something I've talked about, the only way the Federal Reserve can avoid a Great Depression and a huge stock market and housing market crash is if they actually change the data again. Because remember, they could just simply go in there, they can manipulate the books, they can cook the books, and with just a few keystrokes and creative accounting, they can say, well, look, we're actually having deflation now, so we need to drop interest rates to zero and start the money printing again. But again, every action has a reaction and has a huge consequence. If they do this, we're going to see hyperinflation. And people, I've just been notified of something very, very alarming that has just happened over the past 24 hours with the US debt clock. Look at this. This is absolutely crazy. So this is the US debt clock, $31.5 trillion in debt. And people, they're definitely not going to be able to afford to repay that with interest rates at 5%. But have you seen what's happened to the dollar to oil ratio, the dollar to silver ratio, and the dollar to gold ratio now? Look here, it's saying the dollar to oil ratio is now at $0 per barrel. It's now saying here the dollar to silver ratio is $0 per ounce, and the dollar to gold ratio is also zero. Now this just may be a technical glitch or an error, but people, there will come the day that the US dollar is going to become worthless. Every single fiat currency in history that's ever been created has a 100% failure rate. Not a 70, 80, 90% failure rate. They all have failed. And you could have barrels and barrels. You could have trillions of dollars of US dollars. But there will be a day where that won't even buy an ounce of gold or silver or a barrel of oil. And the reason why that's going to happen is because the central bank is going to do what they've done time and time again, what every single government has done throughout history. They're going to print the money. They're going to take all the real assets, use fake money to buy it, print the money like crazy until it becomes worthless. You see, it even happened in the Roman times when they diluted their precious metals. So I know what you're thinking. Well, okay, what does this mean for you in simple terms? What this means is, everyone, we are at the risk of the government manipulating the data even worse than they're manipulating now. We already know they're cooking the books. They could be about to make huge, huge changes so the Federal Reserve can pivot lower interest rates so the government doesn't default. Now, there still is a chance that this doesn't happen, and I hope it doesn't happen. I hope the Federal Reserve sticks to the plan of lifting interest rates to 5% and waits till we have proof that inflation has fallen back down to 2%, at least the CPI data. But if they do fake the data, we're going to see hyperinflation like you've never seen before. So what I'm doing to protect myself, and I'm sure what many of you are doing to protect yourself, is buying real assets, gold, silver, land, farmland, real tangible things. Because yes, while the stock market may go up, remember the stock market went up in Venezuela, the stock market went up in Zimbabwe, but that was because the currency hyperinflated. And people, like what happened with Turkey, when their currency was falling, there was a huge rush to real assets like gold and silver. And if the dollar keeps tanking like it is, this is only more positives for gold and silver and other commodities. But everyone, what do you think about this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.